Hi, I'm Jim Marr, and welcome to this session on bond concepts. Now, I feel this is a very important session for anybody that's taking a professional exam where these kind of calculations are involved. So let's go ahead and take a look at valuing a semi-annual coupon bond. Okay, we have our bond that was issued 10 years ago. Our bond has 3 years left to maturity, pays an 8% coupon bond on a semi-annual basis. So what we're looking at here is we're looking at an $80 payment per year, but we're going to pay that twice a year, so we're going to do $40 semi-annually. Okay, very important point here. Don't get mixed up on that. Bonds of equivalent risk have yields of 10% in the market. So what is the current price? So we just don't know what it is actually going to sell for, so we're going to be estimating that using our calculator. So let's go ahead and dive right into our emulator over here. So we need to figure out a number of periods, periodic coupon discount rate, and then our redemption value. So our number of periods, that's real simple. You have 3 years left to maturity times 2 payments per year. So you really have, say, 6 periods left. Our periodic coupon, once again, was 80 divided by 2. That's really a simple one, 40. Our discount rate we're going to be using, our IY, is going to be 10 divided by 2. Once again, because our bond is a semi-annual pay bond. So we want to make sure we divide or multiply all these numbers here by 2. Okay, very important. Make sure you know that and be able to make those calculations. Really simple stuff. And then our future value or our redemption value is going to be 1,000. Okay, so let's go over here and now actually use our calculator again to make this calculation. So we're going to go second. Up here, let's do this first. Let's go second and clear work, right? So we always want to make sure we clear our work. We're going to go second also, and then future value, which clears out our time value and money registers as well. So we're going to do 40 for payment. Okay, I indicated that on the prior screen. 1,000 is our redemption value or future value. We have 6 for our periods, and we have 5 for our interest rate. And here, it's pretty simple. We have all the data we need, and as you see, it doesn't matter what order we put these into our calculator. Then we're going to do compute present value over here, and we see we get a negative 949.24. That negative is pretty much just a convention. Now, what's very important here is you want to input our payment as a positive and our future value as a positive. Now, I look at this from this perspective. This is, say, what it would cost somebody to actually buy this bond today, which would be, say, like a negative cash flow if you're making an investment into this bond. And then what are positive cash flows being received? Well, yeah, that would be your payment and your future value, okay? So that's one way to keep those cash flows, say, straight and the signs straight. Next up, we're going to calculate our yield to maturity here. I'm going to go ahead and I'm going to clear our calculator, get it back to 0. There we go. We have our 10 years. We have our 3 years once again left to maturity. We have our 8% coupon paid on a semi-annual basis. Now we're given the bond's current trading price of $8.95, but we're missing the interest rate, okay, in this particular case. So now our $8.95 is going to represent what? That's going to represent our present value. So once again, we have our number of periods, our periodic coupon, and our future value. And now we're going to simply solve for our interest rate. Okay, so let's go ahead and take a look at how we're going to do that. So I want you to clear out your calculator, second, and then future value once again. And we're going to enter our 40 as our payment. We're going to enter our 1,000 as our future value, okay? And then we're going to enter 6 as our number of periods. And see here, we have our $8.95 as our present value, but make sure you put a negative sign in front of that. That would indicate, say, your purchase of the bond. And then you see we have 2 positive cash flows, our payment and our future value. And now all we're going to simply do is we're going to now be computing our interest rate. Okay, so we just press that. And you can see, rounded up, it's going to be 6.15. But that's a semi-annual yield to maturity. You have one more calculation to go. You need to multiply that bond equivalent yield by 2. Okay, make sure you make that final calculation. Don't make that error. It is somewhat of a, say, a trap door for you, and you come up with our interest rate of 12.30%. Very easy calculation, and for any exam that you're taking, easy points as well. Now we're going to account for bonds that are issued at a discount. Okay, so there's a little bit different take on what we've done before. I'm going to run over here real quick and get our calculator to 0. We have Leeds Corp here. They have a 3-year $1,000 par value bond. So I'm already looking at, in my mind, I'm thinking about periods. I'm thinking about future value with an annual coupon of 10%. Okay, there's our coupon rate. The bond is trading at 9.51. I'm looking at present value there. I'm also going to be thinking about what the coupon payment will be. And then the market interest rate is 12%. So you see we got a lot of numbers going on here. And it's really up to you to determine what we really need to be using. So our market interest rate is what we're going to be using for our interest rate when we make any calculation here. Our coupon, that's pretty straightforward. It's just going to be 10% of our 1,000. So that's going to be our payment. So see, all I'm doing is just going through the case facts and one by one figuring out what different numbers we're going to be needing in order to make our calculation, okay? So now what we're going to do, using the effective interest amortization method, we're going to compute the interest expense, amortization, and closing liability using this information here. All right, let's jump back into our calculator here. We're going to go second, and now we're going to do our future value once again to clear out our time value of money. We want to make sure we have that empty from our prior calculations. So we have 100, that's going to be our payment. We have our 1,000, which is going to be our future value, right? Then we have 3. Remember, this is an annual bond. Do not confuse that with our prior discussion on the semi-annual bond. 12%. It's going to be our interest rate. And now we're going to compute our present value, okay? And we see negative 951.96. I left the negative sign off here, but you get the idea. Once again, that would be your purchase price on the bond. And we figured out our present value. And remember, the order does not matter when you enter all this information over here on the left-hand side, okay? So now to compute the interest expense, amortization, and closing liability for year 1, and I always think these are pretty neat how we can do all these numbers here. We want to enter our amortization mode. So that's second present value, see AMORT, and you see a P1. Well, we want to do this for year 1, so we're going to do 1. We're going to do enter, right? And then we're going to use our down arrow, and our period 2 is going to be 1 because we're only analyzing our first period. Then we're going to scroll down, okay? There's our closing liability, what we still owe, $966.20. Then you just scroll down. Isn't this wonderful? You just press the down arrow. There's the principal amount that was amortized. And then what was our interest expense as part of our payment? Well, that was $114.24. So those are some pretty neat calculations that you can make using your calculator. And very important also for any professional exam that you know how to make these calculations in case you're being asked about interest expense in a particular year. So how do I say you get good at this stuff? Get in here and practice these numbers. Look at the different time frames that you can use. So if I went back a screen, you can see this is a 3-year bond. So maybe, you just want to do here, maybe you switch this to 2, okay? And make the calculation here just to see how that differs. So I really would encourage you to play around, say, with the numbers in different scenarios in order to see how this affects your calculation, okay? So here's what we're going to do next. We're going to now look at that. We just so happen that we're going to look at calculating this in year 2 for you. So now we're going to just simply go second, and we're going to go present value once again. And now we're going to enter 2, right? So 2, enter, down arrow, 2, enter, down arrow. What's our closing liability as we're getting closer to our maturity value of 1,000, right? We're at $982.14. Now our principal, that was the amortized discount, was $15.94, and the interest expense was $115.94. So there you go. That indicates how we're going to make these calculations for year 2. All right. Oh, look at this. Now let's look at this for year 3. I think that would be important as well. So let's go ahead to second, and we're going to go present value, okay? And now we're going to change our periods to year 3. And we're going to go down here once again to year 3. So I get to walk you through this entire thing here. Look at that. Our closing liability just so happens to equal our future value, right? So our closing liability is our $1,000 of the bond value at maturity, and then our principal we paid that year was $17.86, our amortized discount, and then our interest expense was $117.86, say round it up. All right, so let's look at how we account for these bonds issued at a discount here. And this is just pretty much putting in the numbers that we went through in these 3 years into a table for you. Maybe you would do this in an Excel spreadsheet or so on. But here's a liability on the balance sheet, $951.96. And this would be what would be appearing each year until redemption, okay? And we saw that indicated as we went through our various calculations. There's the interest expense that would be recorded each year. Our coupon does remain the same, right? So what we're really doing here is we're looking at interest expense being our coupon paid plus the discount amortization each year, okay? And that reconciles our numbers, for, if you will, for our accounting for bonds issued at a discount. Now, what if the bond paid semi-annual coupons, okay? And I'm going to put a little question mark there. So we pretty much have some of the same information, but we have a 3-year, $1,000 par value. Here we go. I'm looking at my numbers here. Future value, semi-annual coupon at 10%. But, ooh, look what I could have done. I could have hit that tripwire because remember, it's a 3-year, but it's semi-annual, so the end's going to be 6, right? Future value is still going to hold at 1,000. The semi-annual coupon at 10%. Be careful of that as well. We're looking at, it's once again a semi-annual payment, even though we're really giving you, say, an annual number here, okay? So that would be $100 for the year, which translates in now $50 every 6 months. And we can see that's going to be reflected down here under our payment. And our market interest rate is 12. Remember, you got to divide that by 2. So we're going to take our N, you multiply that by 2. Then for our interest rate, we take whatever is given and we divide it by 2. And then for our payment, we're going to take our payment, whatever that is on an annual basis, we're going to divide that by 2. So make sure you do that for semi-annual bonds, otherwise you're going to make an egregious error, okay? So let's go over here to our calculator once again, and we're going to go second. I'm going to go down here and clear everything out. Let's go there. And now we're going to clear out our time value and money keys. And we're going to enter our information again, and order doesn't matter, as you are probably aware at this time. You go $50 for your payment. Let's do $1,000 for our redemption or future value. We're going to do 6 for our N. Make sure you enter these properly. 6 for our interest rate. And now we're going to compute our present value. What do we get? We get 950.83 rounded up right here. And you can see once again the negative that it's shown in the emulator. I chose to leave out that negative here, but that would represent, once again, if it's a negative, think of it as a cash outflow from an investor. Think of a positive if cash flows coming into an investor. And that's why, once again, our payment and our future value here are going to be positive numbers, okay? So now to compute the interest expense, amortization, and closing liability for year 1, this should look like a similar exercise to what we've just done. Second present value. There's our 1. But now what we're going to look at doing is we're looking at closing liability for year 1. We have 2 periods though, right? Our bond is a semi-annual bond. So now we got to account for 2 periods, not just 1, okay? So we did our enter key here, and then we're going to scroll down. P2, we got to enter 2 because we have 2 periods, even though it's, say, 1 year. And then we're going to press down on our thing here. On our calculator, we see 965.35, 14.52, and then our interest expense at 114.52. Very straightforward calculation. Now let's go ahead and take a look at year 3. So we're going to throw a little bit of a wrinkle in here. We're going to skip year 2. All we need to do now is we're going to go second, and we're going to enter our amortization mode. We're going to do 5 because that's the, say, the period that we're looking at here. Enter, and I'm going to draw this up in just a second on a quick timeline for you. And then we're going to do enter here. So if we're looking at, say, time 0, okay, we have various different pieces of the pie. If we're having a timeline going out, sorry about, it's not quite the scale. This would be period 1, 2, 3, 4, 5, and then 6 out here. So these would all represent, say, a year. That would be the end of year 1. This is the end of year 2. And then we have 6 is the end of year 3. And each of these is semi-annual, okay? So that's the way I want you to view that. So we're really looking at viewing what's going on in this 3rd year right there, which are periods 5 and 6, okay? What's our closing liability? You probably know the answer to that already. It's going to be our redemption value. There's our amortized discount. and then is our interest expense once again. All right, now let's take a look at our numbers that we saw back a few pages ago when we looked at an annual coupon. There's our liability on the balance sheet each year, our bond redemption value. And once again, our interest expense is going to be two components, right? On our discount bond here, our coupon interest paid plus our discount amortization. And you can see there, we're getting to our interest expense each year. So once again, you might want to set this up if you so desire. But like I say, how do you get good at this? It's a lot of practice. And then also seeing what's going on. And I think this is really, important for any professional exam related to finance. All right, now let's take a look at a problem here. We have a 6% semi-annual coupon bond that matures on November the 11th, 2000 X8. The coupon dates are November 11th and May 11th of each year. The day count convention is 3360. The bond is sold on settlement on July 11th of 2000 X4, and the yield to maturity is 4%. We're going to calculate three things. We're going to look at the clean price, the accrued interest, and also the dirty price, okay? So let's see how we're going to do that here. We want to make sure our calculator is set to the date in the format you wish, whether it be European or US, okay? So let's go ahead and take a look at how we're going to do that. Well, I got to come over here and clear out our calculator, right? Let's get to 0, perfect. Second, we're going to enter our bond mode, so second 9, and then we see our date here, okay? And we're going to enter 11.0714, okay? And that enters the bonds purchased in European format, and we're going to go with November the 7th of 2000 X4, okay? So let's go ahead and do that. We're going to press enter, and then we're going to scroll down, okay? Now, if you want, you can do the US bond, okay? So let's go ahead and change that to the US bond format. And to do that, you go 7.1114, okay? And then enter, and then scroll down, okay? All right, so that's the way I would prefer to do it. I'm based in the United States, so I will use that convention. All right, so the coupon. What was our coupon? Well, it was 6. It was 6, right? So let's go back. Let's go back and take a quick look at that. So let's go back here. We can see that we had a 6% semi-annual coupon. So that's the coupon that we're dealing with here. So we're going to go 6, and we're going to do 6%. Enter. We're going to scroll down, and then we got to enter our redemption date, and we're going to do that in US format. Actually, it happens to be the same in either format. I think we did that on purpose for learning purposes, so we wouldn't make a mistake for you. 11.1118, okay? It just so happens that's the way it's going to work out. And then what we're going to do is scroll down, okay? So now let's take a look at this here. Whoops. So we're going to have our redemption value as a percent of par, and our redemption value is 1,000% or 100% of par. I'm so used to saying $1,000. Make sure your day count is set to 360. So if your calculator shows ACT, use second. Enter to change. So let's see what we're going to be doing here. So let's go down here and press our down, and then we see ACT. Make sure your count is there. So if your calculator shows ACT, use second, enter to change. So let's go second, enter. Hey, there's our 360. Perfect. And then we scroll down, and then we see 2Y. Oh, so see, now we're compensating for our semi-annual bond, okay? If your calculator shows one time, use second, enter to change. But we're already there because he has 2 periods or 2 payments a year, okay? Very important now we get that right as well. And then we're going to scroll down once again, okay? And we can see here, when we scroll down, okay, we're going to enter 4 as our yield. Let me go back over here to our emulator to get that 4 in here for you. And that enters the bond's yield to maturity, so that's going to be 4, okay? And we're going to scroll down, and then principal, we're going to compute the bond's clean price, okay? So that's what we're going to compute now. We're going to compute our price, which is 107.8786, okay, rounded up, or say 10788, okay? So that computes the bond's clean price as a percent of par, 107.8786% of par, okay? And our accrued interest is going to be 1, and then our dirty price is simply our clean price plus our accrued interest, which is 108.8786.